Hello. Welcome to Capital Street. Today we would like to discuss some very basic concepts of the commodity market. So, let's begin by asking, what are commodities? Commodities are hard assets ranging from wheat to gold to oil. Since there are so many, they are grouped in three major categories: agriculture, energy, and metals. In the first category, agriculture, commodities are divided into smaller groups which include softs market, things you drink such as cocoa, coffee or orange juice. The second small group, grains, are identified as cereals suitable as food for human beings, such as wheat, corn, soybean and rice. Livestock are the third one, which are animals that become food. This small group includes feeder cattle, live cattle, and lean hog. Feeder cattle are weaned calves which will be sent to a feedlot with the goal of putting on weight aggressively. Meanwhile, the term live cattle refers to cattle that have reached the necessary weight for slaughter. The process of transforming feeder cattle to live cattle usually takes between 3 to 4 months. Lean hog is a term referring to butchered pigs regardless of paunch. The last group are things that you wouldn't eat, such as cotton and lumber. The second main category is energy. This category includes crude oil, natural gas, gasoline, heating oil and some newer entrants like electricity and coal. And the last but not the least, metals includes mined commodities, such as gold, copper, silver and platinum. Commodity production is often a localized affair, as each raw material market has its individual characteristics. As an example, the majority of corn and soybean production in the world comes from the fertile lands in the upper Midwest of the United States. The largest producers of rice are located in Asia, in China, India, and Vietnam. The mineral-rich soil of Chile has helped this country take the top spot in terms of copper output. Half the world's oil reserves are located in the Middle East, while US and Russia are the big guys in the natural gas market. As you can see, commodity production depends on climate and geology in specific locations. However, consumption of these important raw materials is ubiquitous. When it comes to the price of commodities, the vast majority of these raw materials use the dollar as a pricing mechanism for global trade. That is because the US is the strongest and most stable economy in the world, and historically most of the centralized exchanges that allowed trading in these commodities sprang up in the US. Therefore, commodity traders often keep a close eye on the value of the dollar. When the dollar strengthens, it means that commodities become more expensive in other non-dollar currencies. This tends to have a negative influence on demand. This is why the dollar has such an important role in influencing the price of commodities. In the next video, we will learn how to invest in commodities using options, futures contracts, stocks of commodity-related companies or mutual funds and ETFs specializing in commodity investments. Before we meet you next time, you can go to Capital Street and open a free demo account to have first-hand trading experience with commodities and many other instruments. Thank you for watching.